Every cent you keep in the bank is used to play a massive game of earning free money. They earn a risk-free spread of 4 to 5% on your cash. Yet in return, they give you a measly 0.01% interest. But right now, a disruptor has entered the game looking to give that money back to you. Naturally, the banks have started to panic and are doing everything they can to block this. Even Donald Trump has stepped into the ring, accusing banks of threatening and undermining legislation to protect their profits. Meanwhile, Coinbase shares recently surged by 15%. Stay tuned, because even if you know nothing about stablecoins, by the end of this video, you'll understand the trillion-dollar fight that is about to rewrite the rules of finance. Before we dive in, just a quick reminder that this is for research and sharing purposes and does not constitute investment advice. Understanding the logic is always more important than the trade itself. How do banks make money? Let's start by understanding the foundation of the entire conflict. The core logic of the bank's gold mine is simple: the interest rate spread. When you put money in the bank, it's an asset to you, but on the other hand, it's cheap raw material for the bank. They pay you almost nothing for your checking account, but they immediately turn around and lend that money out or buy treasury bonds to earn a steady 4 or 5% return. On average, banks are sitting on about $20 trillion in deposits, which means that the 4% spread represents a massive, rock-solid moat for their profits. Now, you might be thinking about how much interest your bank account actually provides. How do they get away with paying so little? Their official excuse is that they provide safety through FDIC insurance, payment networks, and physical branches. Essentially, they argue that your money is cheap because you are paying for the security. This key concept here is called fractional reserve banking. Banks don't keep 100% of your money in a vault. They only keep a tiny fraction and lend out the rest to generate more wealth, which allows for a single dollar to create several dollars worth of credit. Bear this in mind, because it's the exact trigger for the current explosion of conflict. Stablecoins are changing the game. Stablecoin issuers decided they could play this game too, but much more efficiently. Take Circle, the issuer of the world's second largest stablecoin, USDC. Their logic is nearly identical to a bank. You give Circle $1, and they give you 1 digital USDC. Then, Circle takes your dollar and buys US treasuries to earn interest. It's the same spread-earning business, but Circle is a much leaner challenger. First, they operate on a 100% reserve system. Every USDC is backed by a real asset, so they aren't playing the high-leverage game of fractional reserves. Second, they don't have to pay expensive FDIC insurance premiums or deal with the complex capital requirements that banks do. In the eyes of the banks, this low-cost model is nothing but regulatory arbitrage. These days, the stablecoin market has become too big for Wall Street to ignore. Though what really makes banks nervous is the profit sharing. Circle shares the interest from those reserves with Coinbase, the largest US crypto exchange. In 2024 alone, Circle paid Coinbase about $900 million in distribution fees. Right now, the banks and the crypto giants are looking at the exact same cake. The only difference is whether that interest should be given back to you. Will deposits shift out from banks? This brings us to the powder keg of the interest war. Who will own the interest? From the bank's perspective, this fear is real. If a user can get a 4% annual yield by holding stablecoins as compared to receiving 0.01% in a bank account, rational money will flow toward crypto like a tidal wave. If a massive drain on deposits happens, it'll undoubtedly create a chain reaction. When banks have less cash to lend, credit will shrink, and interest rates for mortgages and business loans will skyrocket. This could ultimately hurt the real economy. Citi predicts that by 2030, stablecoins could replace up to $908 billion in bank deposits. Bank of America's CEO has even warned that $6 trillion could leave the banking system entirely. So the bank's fight isn't just about protecting profits, it's about keeping the massive credit machine from shrinking. On the other hand, crypto advocates have fired back by questioning why banks should have a monopoly on paying interest. They argue that banks just want to protect their source of cheap money rather than actually worrying about financial stability. What about you? What do you think banks are most worried about? Let us know down in the comments below. The GENIUS Act Loophole. In July 2025, the US finally passed the first federal-level stablecoin law. The GENIUS Act requires issuers to have one-to-one reserves and limits investments to treasuries or cash. But the most controversial rule is that issuers are strictly forbidden from paying any form of interest or yield to holders. This was supposed to be a defensive wall for the banks. However, reality is a bit more creative. The stablecoin market often operates in a three-party model. While the law stops a sender from paying the holder directly, it doesn't stop Circle from paying interest to Coinbase. Coinbase then takes that money and gives it to users as a reward for holding USDC on their platform. On your screen, you don't see interest, but you'll see a holding reward. This is the heart of the dispute. The law bans issuers from paying holders, but it doesn't clearly define who the holder is. Is it the middleman, Coinbase, or the end user? Circle claims they aren't breaking the law by paying Coinbase, and Coinbase claims they are giving loyalty rewards similar to receiving credit card cash back. Obviously, the banks are absolutely furious, calling this a blatant disguised interest payment that must be shut down. President Trump's stance. In January 2026, the Senate tried to pass the Clarity Act to close this loophole. It looked like a major win for the banks until Coinbase withdrew its support for the bill, noting it would wipe out 20% of their revenue. Surprisingly, the legislative process actually stalled because of this. Then, on March 4th, President Trump met privately with Coinbase CEO Brian Armstrong and took to social media to blast the banks. He stated that the GENIUS Act was being undermined by bank threats and that Americans should earn more from their own money. Yup, you guessed it, the market's reaction went wild. Coinbase stock jumped 15% in a single day, while JPMorgan and Bank of America saw their shares drop. There's even a bit of gossip from the World Economic Forum in Davos. Reportedly, JPMorgan CEO Jamie Dimon ran into Brian Armstrong and used some choice words to describe his views. You can really feel how personal and intense this rivalry has become. Clearly, this interest war has escalated into a high-level political game. The real reason behind Trump's support. There is another layer to this competition that most people might miss. The GENIUS Act forces stablecoin reserves into U.S. treasuries, which means that the larger the stablecoin market grows, the higher the demand for U.S. government debt. Essentially, stablecoins are becoming a new funding tool for the government. If stablecoins reach trillions of dollars by 2030, it'll create massive new demand for treasuries. For a government with over $36 trillion in debt, this is a side effect they can't ignore. Doesn't this explain why Trump is so supportive? It's because stablecoins are actually strengthening the global use of the dollar. Furthermore, there is external pressure that Trump simply can't ignore. China's central bank recently announced that commercial banks would start paying interest on digital Yuan wallets in 2026. If the US bans stablecoin interest while the digital yuan offers it, the dollar could lose its edge in global payments. This turns a domestic industry spat into a geopolitical currency race. The final prediction. So, how will this ultimately end? Personally, I expect a compromise. Stablecoins won't be eliminated, but they will be brought into a tighter regulatory frame. Transaction rewards for spending might be allowed, but passive income just for holding might be restricted. Meanwhile, the banks will eventually join the party. The GENIUS Act allows banks to issue their own stablecoins. By 2027, big banks like JPMorgan will likely launch stablecoins for the general public. At that point, banks will stop being blockers and start being participants. The biggest victims won't be the giant banks, but the small community banks that rely heavily on cheap deposits and don't have the resources to pivot. Who does your money belong to? More specifically, who should get the interest generated from your money? The banks say it belongs to them for the sake of financial stability. The crypto industry says it belongs to you for the sake of fairness. As Trump put it, Americans should earn more from their own money. The final answer will probably be somewhere in the middle. But one thing's for sure, the result of this fight will reshape everything from your bank account rate to the global status of the dollar. I'll be tracking the final rulings of the Clarity Act this July, so remember to subscribe to our channel and stay tuned. With that, we'll see you in the next one.